Good morning and welcome to T-Hub Capital, the Investors Lounge, the podcast where we explore financial market dynamics, emerging trends, and the insights that shape successful investments. Each week, we'll delve into the strategies and analyses that drive our investment decisions. You'll get an insider's perspective on the factors influencing markets and the potential winners and losers of tomorrow. Subscribe to the podcast to stay ahead of the curve and make informed investment choices. Enjoy listening.
Welcome to T-Hub Capital's The Investors Lounge weekly newsletter. Today's date is the 3rd of June. Let's dive into the week's stock market news. European markets rebound on trade hopes and rate cut speculation. European equity markets closed higher last week, with the pan-European stocks Europe 600 index ending 0.65% stronger, after US President Trump indicated he would grant the European Union additional time to negotiate a trade agreement before imposing 50% tariffs. Contributing to the improved sentiment, slowing inflation in several major European economies further fueled expectations that the European Central Bank ECB might soon cut interest rates. Reflecting this optimism, Germany's DAX gained 1.56%, Italy's FTSE MIB advanced 1.55%, and France's CAC 40 index added 0.23%. The UK's FTSE 100 index also recorded a positive performance, tacking on 0.62%. Inflation in some key Eurozone economies indeed showed signs of deceleration. Preliminary headline inflation in both Spain and Italy eased to 1.9% in May, settling just below the ECB's 2% target. France's consumer price index saw a year-over-year increase of 0.6%, a moderation from the 0.9% inflation rate recorded in April. In Germany, the annual rate of consumer price increases stood at 2.1%, a decrease from the 2.2% reported a month earlier, though still exceeding the consensus estimate from a Bloomberg survey. This widespread slowdown in inflation has led experts to anticipate that the ECB could implement another quarter percentage point cut to its key deposit rate at its upcoming June 5 meeting. However, a counterpoint emerged from the ECB's Consumer Expectations Survey for April, which indicated that households in the euro area now foresee inflation at 3.1% over the next year, an increase from 2.9% in March, a reading that runs contrary to the central bank's own projections for further deceleration in inflation this year. Meanwhile, the German labor market experienced an unexpected weakening. The number of unemployed people in Germany rose by 34,000 in seasonally adjusted terms in May, reaching 2.96 million. This increase surpassed the 10,000 forecast by analysts in a FactSet poll and brought the total just shy of the psychologically sensitive 3 million mark. Further indicating weaker demand for labor, job openings declined by 67,000 from year-ago levels, settling at 634,000. In the UK, business sentiment within the services sector, which constitutes the largest portion of the economy, softened considerably. Business confidence fell to a 2.5-year low in the 3 months through May, a decline attributed to the recent hike in employment tax taking effect and growing expectations for future price increases, according to the Confederation of British Industry. Investment intentions, overall business volumes, and hiring activity also showed signs of cooling. Separately, the Society of Motor Manufacturers and Traders reported a significant contraction in vehicle production. Total car and commercial vehicle output in April plummeted by 15.8% from a year earlier, reaching 59,203 units. This figure represents the lowest output for that particular month since 1952, excluding the period impacted by the coronavirus pandemic. Now our insight into alternative markets, the resilient evolution of biotech venture capital. Insights from a complete market cycle. The landscape of biotech venture capital has undergone a profound transformation, meticulously detailed in PitchBook's analyst note released on May 29, 2025, titled The Evolution of Biotech VC Funds. This comprehensive report, spanning the period from 2012 to 2024, meticulously charts a full market cycle encompassing a period of rapid expansion, a subsequent peak, and a return to more normalized baseline levels. For both discerning investors and astute fund managers, these findings offer critical insights into prevailing performance trends, underlying structural shifts, and evolving regional dynamics, collectively underscoring the escalating importance of specialized expertise and strategic capital allocation when navigating the inherent complexities of life sciences investing. The PitchBook report delineates a complete investment cycle within biotech VC, a trajectory fundamentally shaped by fluctuations in the cost of capital, prevailing conditions in exit markets, and strategic reallocations specific to the sector. From 2012 through 2024, the biotech venture capital ecosystem witnessed a significant surge in activity, largely propelled by groundbreaking innovations in critical areas such as gene editing, precision medicine, and advanced biologics. This vibrant period culminated in a peak, occurring during times characterized by an abundance of available capital and highly favorable market conditions. Subsequently, the market experienced a notable contraction as rising interest rates and increasingly constrained exit markets, evidenced by a reduction in initial public offerings (IPOs) and fewer merger and acquisition (M&A) opportunities, prompted a necessary reset. By 2024, the level of activity had effectively stabilized, returning to historical norms, a clear signal of a potentially sustainable foundation being laid for the imminent next wave of biotech innovation. This cyclical pattern unequivocally underscores the inherent volatility in biotech investing, a domain where high capital intensity coupled with protracted development timelines serve to amplify sensitivity to broader macroeconomic shifts. Nevertheless, the return to baseline levels conversely suggests a maturing market, one now seemingly better positioned to judiciously balance both risk and reward in the years that lie ahead. One of the report's most compelling findings lies in the pronounced performance divergence observed between biotech-focused and non-biotech venture capital funds. In recent vintages, funds primarily dedicated to the biotech sector have consistently outperformed their counterparts with broader investment mandates, a notable reversal of earlier trends where more diversified or general tech VC strategies held a distinct advantage. This significant shift profoundly highlights the intrinsic value of deep sector-specific expertise, particularly during periods marked by capital scarcity and pronounced market turbulence. Biotech's sustained outperformance can be attributed to several critical factors. Specialized funds are inherently better equipped to expertly navigate the unique regulatory, intricate scientific, and formidable commercial challenges that are characteristic of the life sciences domain. Furthermore, continuous advancements in drug development and sophisticated diagnostics have consistently driven high-value exits, even within otherwise constrained markets. For instance, targeted therapies and novel rare disease treatments have historically attracted substantial merger and acquisition activity, richly rewarding funds that possess deep domain knowledge. This prevailing trend emphatically underscores a crucial truth. In the realm of biotech, expertise is not merely an advantage, it has become an absolute necessity for success. The report additionally brings to light significant regional and structural transformations occurring within the biotech VC landscape. North America steadfastly maintains its position as the dominant global hub, with the United States singularly accounting for the lion's share of both deal flow volume and deployed capital. Concurrently, Asia, which was once hailed as a rising star in biotech VC, has experienced a relative decline in overall activity, a shift potentially attributable to evolving regulatory hurdles and changing investor priorities within the region. Europe, while indeed demonstrating continuous growth, regrettably continues to lag significantly behind North America in terms of overall scale and investment magnitude. Structurally, the biotech venture capital market is also exhibiting clear signs of consolidation. Capital is progressively being concentrated into larger investment vehicles and well-established institutional platforms, a development that mirrors a broader industry-wide trend toward increased professionalization. Smaller, more generalist funds are gradually ceding ground to specialized, well-capitalized players who possess the requisite resources to effectively support complex, inherently high-risk biotech ventures. This ongoing evolution strongly suggests that both substantial scale and specialized expertise are rapidly emerging as critical differentiators within an increasingly competitive market environment for both shrewd investors and adept fund managers. The insights gleaned from the PitchBook report serve as an invaluable roadmap for strategically navigating the forthcoming phase of biotech venture capital. The data unequivocally points to three paramount takeaways. Firstly, specialization is paramount. The confirmed outperformance of biotech-focused funds robustly underscores the imperative need for profound sector-specific expertise. A nuanced understanding of intricate clinical trials, convoluted regulatory pathways, and dynamic market dynamics is unequivocally critical for successfully identifying high-potential opportunities while simultaneously mitigating inherent risks. Secondly, selective capital deployment is essential. With capital increasingly being concentrated in larger funds, disciplined and judicious allocation becomes absolutely paramount. Fund managers must meticulously prioritize ventures that are meticulously aligned with emerging innovation priorities, such as revolutionary AI-driven drug discovery methodologies or groundbreaking personalized medicine initiatives. Lastly, adopting a long-term perspective is indispensable. The comprehensive completion of a full market cycle vividly highlights the profound importance of patience when investing in biotech. Protracted development timelines and inherently volatile exit markets necessitate an unwavering focus on sustainable, high-impact opportunities rather than chasing fleeting short-term gains. As the biotech VC market embarks upon a new phase, the invaluable lessons gleaned from the period of 2012 to 2024 provide a robust foundation for strategic decision-making. The recent stabilization of activity at historical levels powerfully suggests a market that is actively recalibrating for enhanced resilience, presenting compelling opportunities for those astute enough to effectively combine profound scientific insight with astute financial acumen. For investors, the underlying message is crystal clear. In a sector inherently defined by both profound complexity and immense potential, an unwavering commitment to specialization and judicious selectivity will ultimately serve as the driving forces behind long-term, enduring success.
Thank you for listening to this episode of Hub Capital, the Investors Lounge podcast. I hope you found this content interesting and inspiring. If you enjoyed this episode, don't forget to subscribe to the podcast so you don't miss a single episode and share it with your friends and colleagues who might be interested. To learn more about T-Hub Capital and our activities, visit our website, hubcapital.com. You can also follow us on our LinkedIn page. See you soon. All the best from the T-Hub Capital team.